Good, Maria.
Hey, how are you?
Good. So I have really bad internet. I may get kicked out. Just FYI, I don't know what happens, but wanted to get it started. So do we want to let everybody be a panelist to see their pretty faces, right?
Then they can see who's on it.
Yeah.
Hey, Maria.
Okay.
Hey, how's it going?
Good. Hey, can you text me the link to sign? My phone didn't get it for some reason. I logged in from my Zoom account.
It's in the massive capital. What's up?
Okay.
Sure, just put it right now.
Cool.
Mike, it said the host has stopped the video. So I can't turn on my video. But that's okay.
Let me start with this. How about now?
Yep, there you go.
All right.
Good. So we'll just promote everyone to panelists, Maria?
Sure.
Or do we just do allow to talk? They all move in, right? You just click on allow to talk.
Oh, allowed to talk. Yeah, but then you can't see the video.
Okay. Okay. Yeah. Go ahead, Mike. You know better. I don't know.
We're changing for our next one just a regular Zoom meeting. So it's
So weird. I'm trying to, can you guys hear me?
Yes, we can.
yes.
How come I can't be on video? I think because I signed up as an investor to see what their experience was. So it's not letting me be on video.
Give us a minute.
And
Give
the
us
chat's
a minute.
disabled too.
Okay. Let me, did you share maybe on WhatsApp already where we could just join a different link, or is it the same regardless?
It's the same.
Just give us a minute.
It's
Okay, no problem. Must be me, operator error. Oh my.
No, it's with the sum of the setup.
I'm just not cool enough to be on camera. It's all right. It's cool. All right.
Just
No stress. It is what it is. All right. I'll just check out your guys' pretty faces then.
Mike, you better watch out.
Just-
That Brooke is laying it out today. She was like, Thanksgiving is here. I gotta make my dinner. There you go.
Hey guys, how's it going?
Hey, Shane. Hey, buddy.
Hello, everybody. This is Jasmine.
Hello.
I'm here, even if you can see me.
Let's see.
Yeah, it says you can't start your video because the host has disabled it.
What is
Hey
Yeah.
team, how's it going?
No stress.
It's Vlad.
it good?
What's happening, Vlad? How are you?
I'm wonderful, thank you. I'm really excited to check this thing out.
Beautiful. I'm glad you decided to. I was chatting with you a lot today.
Yep,
You were my BFF.
Of
Sorry, I
course.
didn't mean to like bombard you, but have you landed yet?
yes.
Beautiful. Welcome to Montana, yo. It's
No.
beautiful out there. Enjoy the snow.
All right, let me see if, hold on.
Making progress there. I see that there's some unmute availability.
Hey, Chris, good to see you. Glad you made it.
Hey, how are you? Good.
right, I'm in. I just can't show my video, so, but that's okay.
I'm pretty sure Mike has to go in and physically hit it for every single person. It's gonna take.
We're-
Oh, goodness. Yeah,
We'll get patience.
we love you, Mike.
So we wanted this to be a Zoom meeting, and that's how we're doing them going forward. This got set up as a webinar, which it had some other control setups, so. We are, the good part is we're all here.
Correct.
You guys can all use chat now as well. See if y'all can chat it up a little bit. See if that's working for everyone. We'll use the chat instead of Q&A for, there we go.
Awesome. We'll get started in a couple of more minutes.
Hey, Mike, I'm trying to get on the video here and it's saying you can't start your video because the host has stopped it.
Yeah, I was trying to fix that.
Okay.
We get,
Thanks.
we get, let's see here. I got- let's see. Oh, there we go. Ah, here, okay.
Oh, nice. Pensacola sounds really good right now.
This may, I'm gonna see if this may kick Marie. I'm gonna see what happens here.
No
You
problem.
still co-host, Maria? Yeah,
Yes, I am.
okay. Shane, are you able to see if you can share your, see if you
Yes,
can?
Shane. Okay,
Yeah.
Shane is in.
I'm in.
Oh, there you go. Okay, man.
Whatever you did, it
I
worked.
gotta work. I'll work on everyone else. You may have a lot of co-hosts in here by the end of this meeting.
That's fine.
Everybody be nice. Everybody play nice, okay?
Please, I'd appreciate it.
Mike is like, hey, before we get started, let me set the rule. Be nice. Play nice. Got it.
Everyone must
Okay.
raise their hand. I'm just kidding.
Let me share my screen. Then let me know if you all can see yourselves, please. Am I sharing my screen, by the way?
Yep, we can see it.
Awesome. Mike, let me know when to get started and I'll kick it off.
Hey, you guys can go ahead.
Cool. All right, it's 6:06. First of all, thank you. I know it's a time for vacation. We're breaking and out from work, going into the vacation time and getting ready for family and Thanksgiving. And so we really appreciate you all joining tonight. So the presentation tonight is from McCallum property that we closed 3 weeks ago. It's 419 units in Dallas. The agenda, first we'll talk about the sponsor team, then we'll give you the summary of the project, then we'll talk about the market and the property, more conversation on the property, and then the business plan, and the last thing is how to invest with us. From us, GP team perspective, I have from Massive Capital, we have the Massive Capital team, almost everybody except Sanjay and Ajit. Sanjay is in India. He's traveling with his family, and Ajit, he has his hands tied up today with the kids. And then also we have Shane from Hampshire. Shane, do you have Nick on the line or just you today?
No, unfortunately, you just get me today.
Got it. Thank you. All right. So full disclaimer, please take a look at it. I don't want to get into it. In general, past performance is not a guarantee for future performance. We're not a legal service and or a CPA. So everybody here should be an accredited investor. So what you see, happy to get into it, use judgment for the risks and make your own decision. That's this. All right, so let's get to the sponsor team. So what I'll do, we have two teams came together here. We have Hampshire Capital on the left and Massive Capital on the right. I know, Mike, you're in Illinois today. If you want to kick it off on the Massive side, a little bit about you, then me, then we can talk then with Jasmine, then I'll pass it on to you, Shane, to introduce your team as we get into the project.
Awesome. Thank you. Yeah, I'll do quick. And just in case I get kicked out, I may or may not be able to join back. So we'll see what happens. But here from Oblong, Illinois, this morning, town of 1200, a village, I guess. I started my journey in real estate here, actually. So it's kind of cool being up here. And we were walking a 10-unit property today that we are remodeling and changing a community, basically. So currently I'm in about a little over 1,700 units as a GP, 3,200 units overall. Have acquired over the last year and a half, 170 million of assets under management, joined up with this Massive Capital team. And we began our journey together earlier this year and just continue to accelerate, partner with people and partner with a lot of y'all that are in here, I'm sure as well. And, that's, I come from a corporate background, oil and gas, engineering. So that's really that's my story. And I'm going to stick to that one today. Back to you, Shariah.
Thanks, Mike. So I guess here, I know almost more than half of the folks here. So you guys seen us, Massive, when we started earlier this year. So I'm Shariah from Houston. We started Massive December last year. We ended up closing about 8 properties this year so far. And as I work as a CFO, not only looking at the strategy of the team, and also look at the strategic partnership for the other teams as well. And as you may have heard me saying, that partnership works really well when you build it based on the skill, and the relationship comes later, not the relationship first and the skill. Right. So I'm proud to say Massive Capital, when we formed, everybody brought in something unique skill set the others lacked, and we chose not to kind of go into that route. The team really formed that way. So that's, as a Massive, as we're growing, we're also very keen about building partnership with the right set of team where our skills are supplementary to theirs and vice versa. Right. So background about me, I have 2 businesses, residential and commercial. On the residential side, my team buys about 60 to 80 properties a year, depending on the cycle. Last 4 years, we bought a little over 200 assets, mostly in Houston, across all asset classes minus the multifamily. I'll explain my reasons later. So we started the multifamily last year, as you know, 400, a little over 400 units as a sponsor. And, that's how I met Mike, Sanjay, and we've been working together. And Sanjay is not here. He's in India, as I was mentioning. He's the CEO of the company. His specialty is in multifamily. He full cycle, a little over 900 units all by himself before he came into the Massive. So as he came into the Massive and he was the CEO, he brought in that operational know-how, and his muscle is mostly on a Class C and heavy focus in Dallas area. So Sanjay is the COO. I come in as the CFO. Mike comes in as the CIO, looking over the investments funnel, and then a building relationship. On left, this is the unique team. This is a very awesome team. I'll give you a massive flavor of it at the very end when Shane goes. Shane, it's all to you, buddy. If you want to introduce your team and a little bit about you. Please.
Yeah, absolutely. Thanks, Shariah. So yeah, I'm Shane Carter. We're based out of New Hampshire, hence why we named our firm Hampshire Capital. I know, not very ingenious, but that is what it is. So my background is really in, been a general contractor and a developer of real estate here in New England for a little over 20 years. Sort of started small in the multifamily game, started buying 4 units and then 8 units and 20 units and 80 units and so on and so forth. Built myself a nice bit of holdings, and joined forces with a longtime friend and cohort, Nick Bouquet, late in COVID. Sort of started thinking about what was going to come next for us. He was interested in leaving his firm where he was a principal in a LIHTC firm, low income housing tax credits. He did about 2,500 units with those guys, from acquisition through stabilization, renovation, and then asset management. So we joined forces and created Hampshire Capital, and we acquired our first assets in Texas in Q1 of 21. So over the last 21 months, we've done a little over 2,000 units, about 225 million in assets, and we have a very strong growth trajectory from there with the team that we're building underneath us. So one of our key hires this year that we didn't have enough room. We can only show 3 here, but first one is Kevin Groh. He's our VP of Asset Management, also Texas-based, and he's got 27 years of active real estate experience. Most recently, managing close to $1 billion in assets for a very large Canadian-based firm that was acquiring assets in Texas and Arizona. And so Kevin brings a wealth of knowledge and experience to our firm in our asset management platform. We also have a Dallas, Texas-based construction manager named Philip Grills, and he's been with us now through 22 and really manages the day-to-day operations for our construction vertical.
Shane, thank you. Now, on that note, Shane has another 4 or 5 and associates in his team, and we have 4 here. We could not bring it to here, but the point is, all of us, that when we look at both of our teams, we designed our organization as an entity, as a corporation, as a company to build, which is way different than a syndicating team that you'll see, where we have syndicating team, they always bolt onto other partners and keep going, right? That's one of the differentiating factor that both Massive and the Hampshire brings into the table. Now, let me share a little bit more about our view of Hampshire, as Shane was mentioning. So it is really interesting and really impressive how he has grown his organization, and how he was able to accelerate the asset type that Hampshire buys in. And we'll talk about a little bit more financing. To us, financing is an art, and buying 100 units financing structure is way different than buying 500 units. And I believe Hampshire, one of the specialty is how they do the financing, and you'll see an example of this one. And sometimes it is impressive how we can get a limited amount of LP and equity to extrapolate into an extremely large asset. So that financing was a really specialty. They play with the institutional grades. I believe that's where you're going, Shane. And our muscle, our specialty is on the retail side of it. And as we are growing, we thought it's going to be a fantastic partnership where we bring in the retail equity to couple that up, to complement that institutional equity, so that we can make acquisition on solid investments, really good investments. Put together, there's as we talk about it, for us, we don't buy multifamily just to buy multifamily. We buy multifamily because it's the best thing to buy, depending on the macroeconomic view of it. So it's just a simple way, 4 different ways that we take a look at it. What we buy, it depends the risk. It's a project versus the market risk, and how we buy it. We tend to really pay attention to the deal sourcing capability of it. So finding an off-market or pseudo-off-market, leveraging our relationship so that we can reduce the competition, and or find a better assets to kind of make acquisitions. So potentially we could get a higher return compared to the markets. And why we buy it, it's the location that we buy. It's a basic thing. We look at the lens of lenders. So population must be 190,000 or higher. So it's a agency can loan, and also the high job growth, high income growth, low cost of living. And the last thing, one key thing is we try not to go into an unproven market, which is a smaller market. We tend to stay an approved market already. And the last thing here at the right side, it's that instead of just looking at the debt, we look at the capital stack. So we are majority of us are finance folks, and we use, depending on the project, bank debt, coupled that with the pref equity, maybe a mezz, maybe full equity. So it all depends, and you'll see how everything comes together. A little bit of flavor of how where the sponsor team together, Massive and Hampshire owns assets at this point in time. We are in almost like a sun belt, a little bit extended smile, and as you can see, so we have Hampshire is very really good concentration on the South Carolinas. Then put together the Hampshire and us together. We are concentrated in the Houston area. And Sanjay's specialty was in Dallas and Dallas market. That
Recording in progress.
and Dallas market we're trying to do. So put together, we have about 2,400 units under our direct management. We influence and we make decisions which way it goes. So we have a lot of know-hows as we're coming into this asset, making acquisition. All right, so summary. So for us, folks who does a lot of underwriting, I wanted to keep in mind every number's a number. Beyond the number, there has to be some story. And the story really defines the number that we take a look at it. In other words, if a project has X% return, understanding the context and the staging and how we came together is very important to look at the valuation. So with that, we'll give you a little more context, story behind the numbers. So Hampshire has an existing relation of one of the sellers of this property, and they're a retail syndicating team. And Shane was able to leverage that relationship to get in front of this property before it was picked up by Northmark. So again, sourcing the deal is very important. And I believe Shane, within 3 days, 4 days, or less than a week, you turned the whole asset around. Is that right? For the valuation?
Yeah, that's right. We got the rent roll T12. We dove in, we flew out immediately, wrapped our arms around the area, the understanding the asset, the comp set, et cetera, and moved to contract very quickly. Speed is crucial in this business, and that was one of the factors that gave us the edge on this.
Thanks, Shane. And folks, massive, and you know how we operate. For us, we always tell that the speed is the essence. Everybody can take their sweet time and make that offer, but whoever takes the first shot at it, and they should have a higher likelihood of winning a project, and that's why, which is also why this was off market. Our agency to sell, sellers are a sophisticated team, and they bought the asset 3.5 years ago, and we know, okay, one of the sellers Shane knows, one of the seller we know. So it was interesting how it kind of played out, and they are in the market actively, and they also see the market. This project they have delivered their business plan. So, and they also see the market cycle. So so that when Shane went in and negotiated a price and faster close plus the balance sheet plus the resume and the team bio, that was really crucial for us to see, win that deal for us. So the urgency on the seller side was there, and they wanted to get a quick close, hence the lower price. Historical operations, it is interesting. Folks who are in the multifamily business for at least 1.5 years, you may have known that Wayner Multifamily, they're one of the largest used to be one of the largest operators across the Sun Belt. They went bankrupt last year, and they used to manage this asset. And when the bankrupt, the operation took a hit. At some point, occupancy took a really bad beating. Now it's finally coming back up. And as you know, when there is a higher occupancy, you don't push the rent, you push the vacancy or reduce the vacancy. And that's what was happening with this asset. So which is also why the rent is much lower than the market, which we'll talk about it. And also, given the current markets, as you know, the economic outlook in the market, Shane was able to leverage his relationship with some of the specialty brokers to bring in Walker Dunlop for a $90 million equity check. And they're capped out at a 12 IRR. What happens if you think about the value of a project, how much value we can create is fixed. Walker Dunlop came in with a $90 million pref check, and they're going to get 12 IRR. So the rest of the IRR went back to the LP, which resulted to the extremely high IRR compared to today's return that we see on the market. That's what it is. And since Walker Dunlop is 12 IRR, LP investors will be receiving a very high return as a trade-off. And also, one other story, it's a very back end. We had a 1031 funding that fell apart after the closing. That was about $6 million. So that's why we had a gap, but we closed this property. This project was worth saving, and the project makes a lot of sense to take a short-term loan and still move forward with it. So as of now, we closed. It's about 3.5 weeks now. We'll talk about it a little bit more. What's the action? What are some of the execution that is happening? So as of now, the project is closed. We own it, running it, and we have boots on the ground. The call, you are more than welcome to shop, and you'll see as the project kind of goes. Okay. So this is the summary. And we believe it's a setup and the location. It's a very nicely set up for right inflation and capture growth. One thing to keep in mind, there are a couple of points about the Dallas market as you kind of go through it, and I'll talk about it. For the context to that, geopolitics matters, and it matters when it hit homes. So one of the things that we're seeing, the U.S.-China separation and the Taiwan and the high-tech fabrication, high-tech manufacturing, Dallas is taking a big, and Dallas is a very good beneficial of that. A lot of the manufacturing facility, it moved into the Dallas area, and that's one of the reasons that we are bullish in Dallas area compared to some of the other markets in the state of Texas, given all things equal. So that's that. So some of the jobs are fundamental jobs that are coming to stay, even though you hear the Facebook, which is the Metas of the world, Twitters of the world, reducing the job. But if you get over the noise and you can see the manufacturing type of facilities like TI, those type of roles that typically they're coming to Dallas, and we believe the semiconductor industry will be holding Dallas pretty steady. That's number one. Number two, that is not in the typically we don't see, is statistically speaking, if you take last 3-4 downturns that we happen, and if you can see growth before the recession, after the recession, Dallas always comes back out at a much faster rate than any other cities or MSAs within the state of Texas. And you compare that to the US as well. Couple of those two, we wanted to position ourselves into the Dallas market as much as we can, so we can ride both of them, even though we know that 2020, at least our assumption is 2024 or 3, we're gonna go through a recession or down cycle of it. So coming back out would be much better if we can locate and if we can put our assets in Dallas market. So put together, it's a 24% IRR and 2.8x return. And a typical deals that we run, that we look for, and that we buy, and that we are buying right now, we sold for 17 to 19 IRR. That has a 4% higher. And the 5 years return is typically 1.9 to 2.1x, and this project gives us 2.8x. That's because of the pref check that we brought in. Average cash on cash, 5.8. It is lower because year 1, 0, then year 2, 3, it comes back up. To compensate that, to make sure that LPs are protected, it's 8% pref. It's a 75-25 split. And this year, the last year for 100% depreciation. And for now, I believe we're getting about 65 cents a dollar for depreciation in year 1. Then it gets another 25 and 10. All in all, it's somewhat, when one investor invests $100,000, after 5 years, they will get back 185 plus the 100, total 285. So it's almost 3x the return, likelihood of doing a 3x the return on this project that we have. Why we like this deal, as I was mentioning, in a high quality location, is right by the UT, and economics of scale that we talk about is 419. Typically, at a what we talk about from this learning perspective, at a 75 units, you can bring somebody else in. At 100, 50, 180 units, you can have a full-time maintenance, full-time management. And the coolest thing about it, 400 units or 350 units higher, you have a redundancy. That means if one of the maintenance guys gets sick, we have a backup. If one of the assistant manager gets sick, we have a backup. So it's not only the economics of scale, but also a redundancy of the skills available. So if something happens to someone, we're not drying. There's always a backup. And that is the true economical scale that we take a look at it. And the asset is located nicely, excellent submarket in Dallas area, right by the UT. And we'll talk about the rent, how low it is. And we have a clear rent growth upside. And the way we phased, pretty nicely done. First 1 year, we're just catching up to the market. And that is independent to recession if it happens. We're just catching up to the existing rent. So we don't have the upward pressure of pushing the rent in year 1. Year 2, we are doing the value add. So we are past the downturn. Lower leverage transaction. That means, and as you know, we'll talk about it, we're doing a loan assumption at an extremely fantastic rate. And that gives us a lot of cash flow up front, which is what Cardano will be taking it, 2.9%, and also have an IO left. And then the purchase price is also great, 125 unit. We're typically it's about 150-ish. That's the range that we see. Exit cap rate 5.5. most of the underwriting that we do on a Dallas market is a 5.25. For this one, we push the envelope to 5.5, and still the return comes up pretty good. So let's get into now. As we go through it, if you have questions, please let us know, and then we'll capture the notes. We'll reflect back at the end of the presentation. All right, so it's a 419 units, 1984 build, around 91% occupancy. It's 595 square footage on average. Average rent in place almost 800, and average market rents almost 1100. There's a big spread, and our pro forma it's 5 years old. So not only we have a lot of room to slowly grow the rent, and it's not that we don't have to push extremely hard and be on top of the market. As long as we play good, as long as we manage the asset right, we have a very good spread between the average rent in place and the average market rent. Now, when we ran the rent analysis, all the competition is much higher than this. That reflects back to the storyline and how the existing asset management team or the previous seller had the operational hit a year and a half ago. And that's the address. We'll text the address as well. The submarket is Far North Dallas. This one has a blend. It's heavy on the studio, 390, then 1 bedroom and 2 bedroom as well, which is why that brings it down to the smaller size, which is also good because you get a higher dollar per square footage. It's a 14 building. One of the good thing about this project is when the last seller bought it, they did quite a bit of capex. So last 4 to 5 years, roofs have been replaced. So when you look at the capex, we call it capex goes from the outside to inside, then roof and the underneath, which is all those utilities. So in this case, roof has been taken care of. That's not the issue for us. It's mostly it's a value at play for the year 2 for the interior portion of it. We'll talk more about it as we kind of get into that. For the value add, so this picture looks fantastic, and those are the 10% of the value add of an example. But still, we can do value add here. What you see. So what happens? 90% of existing units are classic, and exterior cosmetic improvement, which is already happening, and the amenities enhancements and the income sources, washer, dryer, hookup, and units and the parcel lockers. So the setup is nice. The loan assumptions are there. We have the prep, the property cash flows, minimal exterior upgrade, more of a rehab, or have 90% of the units are in classic condition. So all we have our plan is to take from this to that as we kind of go through. And that's, we'll talk more about it when we get into the business plan execution part. Submarket, this concentrated area, it's for us, we like it. It's $50,000. It's a median income, and this is the rental market, and third highest rent growth submarket. So population projection is pretty high. So people are migrating in, and that's also because it's a rental. So when the house prices goes up, you try to bring it to here. If you think about the spread perspective, the reason it's lower because it's surrounded by the houses, and median house buy is $500,000. At a 7% and $500,000 is quite a bit of rental versus paying $1,000 to come into the tenant base. We don't think it's going to go. Rent is going to take a big beating, as you see on the noise, in terms of rent growth, rent reduction, concession, things like that. So going back to the $300 per unit spread, we are pretty comfortable to realize the spread given the time that we have. Just to give an example of what the rent growth looks like for the submarket, blue is the McCallum, and green is the market. So the spread always existed as you kind of went through, and right here the catch up wasn't there. So this is where the winner was there, and then they're doing some more. But the catch up wasn't there. Typically the projection would have been this way when you have the rehab close to the market. Right, Shane, would you take it from here? Business plan, it's all to you. Just let me know.
Sure. Yeah, no, appreciate it, Shrar. And by the way, you're doing a great job so far.
Thank you.
So yeah, going into our business plan. So we always start with the exteriors first, but the exteriors are just about $815,000. We've already started on it. We hit that quick. We hit that immediately. That always gets accomplished in the first 6 months of ownership of every asset we do. And the reason is we really want to show the existing tenant base and obviously our proposed tenant base, folks coming in to the asset, that we got new ownership. We really care about their home and about our asset. We're showing immediate improvement on the exterior. We've got rebranding. We're rebranding it as The Landing at McCallum. We've got great signage coming, fixing all of it's a reasonably clean asset, but there is some deferred maintenance. So there was some concretes, walkways, patios that need to be surface repaired, minor, fascias, rakes, soffit, sort of wood exterior repair, some siding repair. And then we completely repaint the asset, rebrand it, and do solar screens on the windows to really dress the property up, really make it look completely different than it does now. So we always focus a lot of energy and intensity into that, as well as into the amenities, into the exterior spaces. We've already started dressing those up in terms of the pool areas and those amenity areas. And the residents are already, in just 2 weeks, coming in ecstatic, so excited about new ownership and how much we're improving their home already. So yeah, the office gets a makeover, the exercise facilities get a makeover. We're putting in a parcel package room, and really creating an environment where existing residents and future residents are just going to be excited to have this property to be their home. On the interior renovation program, it's really just appliances, some of the lighting fixtures, plumbing fixtures, repainting the property, repainting the asset on the interior, doing LVP flooring in the entry kitchen areas, living room areas, and doing a tile backsplash. In one of those pictures prior, Shrar, you showed where there's an upper sort of cabinet level in between. Yeah, right there. So we are actually demoing a lot of those upper cabinets too, really opening that space up. And that process as well was something that our construction manager pointed out and said, guys, we think we should do this. I think the residents are going to really give a lot of positive feedback to that. And the leasing staff has already said, yeah, we love that open look, clear those cabinets out. There's still plenty of cabinets on the other side and underneath in that island. And it just gives it a more modern feel. So we're adding some lighting up there and really taking that out. And so, right, the significant rental income upside is the fact that we're already sitting under $800 a month. Yes, the asset is predominantly 1-bedroom units, and so are our neighbors, but the demographics match that. So we're not necessarily concerned with that unit mix. Shrar said it's 91%. It's actually 95% occupied, and we expect to keep it there throughout the renovation process. So there's a huge roll to market, as we call it, loss to lease burn off from the 792 to the 961. And then the bump really for the renovation is just from that, 950, 960 to that 1115. Important thing to point out here, though, is when we did our rent comp analysis, when we did our rent study, we've got 2 assets that flank us on either side owned by Tides Equities. And they're a big group. They're going around buying up a lot of assets in Dallas and Phoenix and really all over the country. But they come in and they spend 15 grand a door, and they do their program, and they spend a lot of money, and they push the rents. And so our thesis is never be the market rent leader or the market leader in rents in the market. And so we're just drafting what they're doing. And so our pro forma rents of $11.15 are actually about $75 to $100 less than what they're pushing their rents to now. And those are our pro forma rents, which are going to be blended, achieved over a 24 to 30 month time period. So we feel like there is sufficient conservatism in that growth for our pro forma rents, and potentially even more upside. So that's the upside in the rents. For our management, we've got best in class third party with Asset Living. They've already taken over. They've hit the ground running. We had engaged them obviously through the due diligence process, so they knew exactly what to do, how to do it. We have a unit matrix that we walk every single unit, create exactly a plan for every single unit, and we're already hitting the ground running there pretty hard. So our active hands-on asset management approach. So we have dedicated members of our staff that are Texas-based. Our construction supervisor, Phil, is there every single day. And our asset manager, Kevin, he's based in Houston, but he goes to Dallas at least twice a month. And for the beginning here, he's actually been going weekly now to check in. And from a construction management standpoint, we manage construction in-house. We procure the materials ourselves. We're working with the direct level subcontractors that are doing the actual work, not general contractors that are then hiring subcontractors. And that is a part of our vertical in our company that is really important, because we're delivering. If you look at the unit renovation cost, $7,700 a unit, guess what? Most people can't achieve that. That is a very low number for what we're doing with granite counters and stainless steel appliances and backsplashes. And I've had a number of investors say, Shane, I don't think you can do that, until I show them our numbers. And we're not marking it up. We're not trying to make money on our construction vertical. We're trying to control costs and make this a better asset and a better investment for all of our investors and for our partners. And so that's our thesis on that. It pays for it. We control the process is really what we're going for there. And so that is an important part of who we are as a company and how we operate. And then from an asset management perspective, we are not hands-off at all. We have best-in-class third party, and we love them and we trust them. However, we drill in with daily and weekly KPIs for them. We make sure that they're doing exactly what they're doing. We ask the hard questions. We drill into the Entrada reports and ensure that that our business model and our culture for this asset is being administered by Asset Living to the T. And that's, I think, a very important aspect of how we manage hands-on.
Shane, thank you. Just to kind of add on that one, from the Massive perspective, Sanjay, the focal point for this asset and the folks who work with Massive, as you already know, that we are also extremely hands-on, right? We ask those, we are comfortable talking about the uncomfortable conversation all day long, right? And when we saw how Shane bringing the culture of his organization, how he goes about it, and what the long-term plan was, it made sense. It made fantastic sense to couple and bolt on to run this asset. So not only he has, we have dedicated asset manager within the organization full-time focusing on this. We also have dedicated CapEx manager looking at the CapEx execution of it. Also have a secondary asset manager from Massive looking at this side by side with Shane. So it's an extremely hands-on exercise. Going back for us, we're really becoming an asset manager running a P&L of this 419 units. Rather, we are the blend between a lifestyle and trying to figure out a way to do it, right? What I say is that this asset class, it's all about the know-how and the reputation of it, less of a learning, right? If you think about how we are doing, we're really implementing a know-how and getting to work day one, rather trying to figure out as you kind of pick up the asset. Thank you, Shane. Back to you about the pro forma. I kind of highlighted the income ratio and the income operating ratio and the debt brief food.
Yeah. So there's a lot of data here on the screen to take in. I'm not gonna pour through every single item. I'm just gonna point out a couple of main things. Number one is you'll notice we're just gonna focus on the delta between the T12 and the year one. And I think this is an important thing to point out that I know that the Massive Capital guys don't do this, but I do see it unfortunately with other operators that bring us deals and ask us to KP for them. And number one, unrealistic year one expectations. And what you're going to see here in our year one expectations is look at the economic vacancy and look at the physical vacancy, right? What the difference between T12 and year one, ours is bigger. We expect more vacancy. We expect more economic loss in the asset while we're also growing the potential rent. And that's critical because in year one, there's a lot of turnover. We expect generally a 30 to 50% turnover ratio on our tenants. We're going from 792 for base rent to 1115. That's a big jump for a lot of folks. And so a lot of folks aren't going to make that. And so we budget for that accordingly because we've done this before and we know that realistically that's what's actually going to occur anyway. You see it then slowly taper down and the physical vacancy number doesn't necessarily go down. What it is in relation to that gross potential rent number is getting so much larger that the physical vacancy number is settling into a typical 5% loss for that. And so just wanted to point that out. And then, of course, the economic vacancy, it blows up in year one, and then we wrap our arms around and get that back down as we get the asset restabilized in terms of the right tenant base that's going to be paying, in that $900 to $1,100 a month range. Important thing to point out too is that, our cadence in our underwriting, and which obviously comes right in here to our pro forma, is not that we're turning 100%, renovating 100% of the units. So 419 unit asset, typical, let's just call it a 5% vacancy. You're going to have 20, 22 units a month that are going to need to be turned, right? In our pro forma, we're only doing about half of those. So the other half, we're turning over, doing a rent ready turnover, and then we're bumping it up that $200 to get it halfway there to that market rent. So we're still growing rents, we're still increasing our revenue volume in that year one, but we're not really pushing the envelope on the renovation too much. I think that's another mistake some folks make. They think they can come in and just renovate the heck out of everything, but you really need to have some time and space for your leasing staff to understand the absorption of the product and let the market understand that absorption rate. And then you can ramp it up or down from there accordingly. Hopefully we ramp it up, which means our revenue growth is quicker. Otherwise, as you can see in the gross potential rent growth from years 1 through 3, we take a slower approach, and we don't think we're going to get there until late year 2, beginning of year 3. If we do it faster than that, fantastic, but we're not expecting to. I just want to point that out. And the expenses, and the expense line item, some of the biggest misses are obviously in insurance and taxes, and obviously we're jumping those up tremendously because we get hard insurance quotes actually, so we know exactly what our insurance is. Obviously we've already paid for it for this year. And then the taxes, we engage with tax professionals that are going to give us an actual estimate of what they believe it's going to be. In this particular case, there's a very strong chance that our year 1 tax number is not going to be that high at all. But again, to be conservative, we have to budget that to ensure that we're protected. But because this is a debt assumption, Texas is non-disclosure, nobody necessarily knows what we paid, and there is a new debt being placed on the property and recorded. So there's certainly a good argument that our tax attorneys are going to make and litigate against the county to keep our taxes hopefully substantially lower than that. Net operating income growth. So at the end, what you see is our year 1 NOI really doesn't substantially grow over what the T12 is, right? And I think that's an important thing that a lot of sort of newer investors also get wrong, is trying to grow that year 1 NOI too much. It just really doesn't necessarily happen. And so we budget accordingly. And then one of the other key metrics we look at is, can we grow NOI about 50% over the first 3 years? And what you see is that's exactly what we do. That's a key metric for us when we're looking at a property. That's how we know we're fundamentally creating value. We're fundamentally ensuring success for the investment. And that's a major thesis of our sort of back of the napkin underwriting, to make sure we're gonna hit that. The rest of these are, your CapEx reserves, pretty standard, asset management fee, pretty standard. The debt service payment, you'll notice year 1 is substantially lower. That's because we have 1 year of interest only left, and then it starts to amortize. So it jumps from that 923 to the 1.5. The amortization is good because we're paying down the debt, right? We're actually, gaining appreciation from the asset accordingly. And as you can see below that, our debt coverage ratio remains strong because of our low leverage and because we were able to get such a good deal with Walker Dunlop for our equity check, which is a soft equity check, not necessarily a hard pay, which is why that debt service coverage ratio is intact, as opposed to a mezz debt or something that is a must pay. Right, here we have our sources and uses. So again, our senior debt is 31.2. Walker and Dunlop equity, we got just under 19.5. LP equity about 8.6, and then we brought about 960 to the table as well. So total is 60.3 million. And then the uses, our purchase price was 52 million, about 1.7 in closing costs, fees, etc. We got 3.895 in renovations with another 389, 10% contingency, always prudent to have a contingency. And then soft costs, reserves, interest payments, things like that, another 2.2 for the balance of that uses. So yeah, what we see on the right side here is a typical return for $100,000 investment, your cash flow based on the cash on cash return, years 1 through 5, and then your profits from the refi sale, and your total return on investment of 185%, which is a 2.85 equity multiple, 23.9 IRR, average of 5.9 cash on cash, annualized that becomes 36.7. Again, the very high equity multiple, and our exit is in year 5. We could have modeled in a potential for a year 3 refi, which would drive these returns even further. But instead, we kept it as a 5-year fixed with no refi, just as a base case. But we will have that as an option. We will always look at that option, see what the capital markets conditions are. Is it intelligent? How much capital can we return to our investors? What does that do to drive IRR metrics for all of us? And is that safe and prudent to do?
So Shane, I'll take it from here. Really appreciate it. So one thing to kind of keep in mind, back to it, it's kind of building up what Shane was talking about. Yes, refi is an option to play, but we that is a secondary option that we do. But in our simplistic manner, it's a 5-year straight hold. We're looking at the macro data. So we believe after 5 years, market's going to turn, get close to the rate that we have. And given the longevity of the loan assumption, we are pretty well set, which is also why we're able to lever it up quite a bit in this project, at least in today's market. As you guys know, how tough it is to get a debt code, and plus how even tougher it is to get a pref equity. And given Walker Dunlop, it's a shell of the real estate, and they were willing to look at this asset and give us a $20 million check or $19 million check. So that in a sense tells you that this is an institutional grade. This is an institutional type return, and the value add is there. And the project has a lot of breathing room. It's not like it has to be a sunny day. It has to be on a Monday. It has to be a 12 o'clock for us to get it, right? The project had some breathing room. And going back to the execution team, it's all full-time, hands-on repetition of from previous projects that we have, rather a learning curve, right? Put together, this is a 506C, and I believe we have the sign-up links on our website. It's what we're asking our investors is do the commitment as soon as you can. We don't have much of a time, minus the Thanksgiving and Christmas for the year-end depreciation. We would like to close the chapter and get this project funded before the year ends, so we can realize the 100% depreciation that we have. It's IRA funds available, 1031. I think around $1 million. It's possible. Shane, is that right?
For the 1031, it really has to be a pretty large check for us to get that to fly with Walker and with Freddie Mac.
Yeah. So anything. So thank you, Shane. So I would like to support this 1031 funds, but given the size of this project and given the approval that they have to do and some of the post documentation we need to do, it needs to be a larger check. But if you have something, reach out to Mike and I or anyone from the massive team I'm happy to answer. So all in all, the takeaway is the asset is set up nicely and a good side and in a good location of the market. So we are on the side of the market. We're not fighting the market. And the return is extremely high compared to the typical projects that we see in today's market, 2.8x multiple to compensate the cash flow for the year 1 and 2. So we are 60% subscribed so far. I would like to close that in 40 days and no execution risk. So, okay, this is one of the things that we need to kind of bring it out. If you think about when the money comes in before the project, it is the money takes the execution risk or the closing risk, then a takeover risk and a capex risk and a market risk, right? All the risks that early on investors will take. So Walker Dunlop took that risk already. And whenever we come in today's market, we don't have that takeover risk and also the closing risk. Those risks are off the table. It's already closed. It's already funded. We own it. The execution risk it's very minimal, and then the market risk is left, right? So half of the risk already been resolved. So that's only the good thing about this project. Okay. And we have some extra data. So all this data, all those slide decks and a detailed team bio for Hampshire and for Massive, and I set in the Dropbox, so you guys can take a look at it. And also, because I shared at the very beginning what our portfolio looks like, but we have more information there, what type of assets that we have purchased, both from the Hampshire and from the Massive into our Dropbox. This slide deck, it's already in the Dropbox. Also, you got a rent roll and T12. So if you want to get into the data, hey, please do so, and happy to answer any questions you may have. All right, how long do we have now? Okay, we have 7 more minutes. Well, it may go a little over. So, and before I get started with the Q&A, we appreciate your time.
Hey, Shane,
Yes.
can you talk a little bit about what you're already doing for rebranding and signage and things?
Sure. Yeah, Mike. So, well, like I mentioned, we chose and selected the name The Landing at McCallum. We've already chosen the logo, the colors that tie in with our exterior color packages. We've engaged with the firm to create the signage, given them the deposit on it, and it's in production already.
Okay, you may have mentioned earlier, I saw a Q&A on it. Just wanted to make sure we covered it. Thank you.
Sure thing.
All right.
And I think you answered the question earlier. The market study really was based on the properties like right next door around you, right? So, but did you have any further on the market study, where it came from, how you guys went about that?
In terms of, okay, so you're asking me about the rent comps?
Yes,
study?
yeah. Who did the market rent value and when it was done?
Right. So my partner, Nick, is, I wish you could be here to speak to this, because I will not describe this as well as he can. He is really the, operations and the Excel savant side of the business. But to answer the question clearly, he actually does our rent comp analysis. And as part of our underwriting, we have an institutional grade pro forma that he created from scratch. Can't say enough good things about this guy. That's why he's my partner. And so what we do for the rent comp study is we select assets that are within a 3 to 5 year window on either side of us, within a 3-mile radius. And we have a proprietary formula that we put into, basically a spreadsheet, right, where we list out exactly where the rent comps. So we pull from CoStar, we pull from Yardi, we pull from, apartments.com. We get all that data together, and we do a comprehensive study of exactly where our asset sits. We actually call around to, we have, some of our junior analysts call and like a property manager would, and understand, what are you leasing for today? What's your LRO showing today for this? What's your renovated units renting for? What are your classics renting for? And we get all that information that's not necessarily, CoStar, the data is a little latent. Sometimes it's not always accurate. So we take that next step and really gather all that information and put it into our proprietary matrix, and it spits out answers on exactly where we should sit, which is, our goal is to buy assets where the rent is in the sort of 0 to 30 percentile, and then take them to that 75th to 90 percentile, so that we're not at the top, but we're in that upper 75th percentile.
Mike, I can add something to it. So as Shane did his team up from the data model, that Excel file that Nick created is pretty awesome. Him and I went back and forth quite a bit, but pretty cool one. So for us, same. We also did the similar study. We have a sales team. Anytime we do something, we don't do a radius. We do, because we are Houston style almost, in the sense we do block by block. So we kind of put a cluster of similar asset size, similar vintage, similar distribution of the properties. So our sales team will call to kind of double check. We make the assumption the data and the CoStar data has some noise to it. So we call to make sure that concession and the discount and whatever it is, that is up to date. And then we did that already for this asset. Then we compared the note with Hampshire, and we got to the same decision at the end of the day. The cluster of the properties made sense. The vintage is there, and the relative positioning of the asset pricing today and the pricing later, right? For us, we do a regression, fourth order regression, if you ask me, just to kind of see a blend of hey, if a property has X% of single bedroom, Y% of, 2-bedroom and Z% of that bedroom, what the combination of the pricing will look like, and then we're gonna come up to an answer. That's the technical answer, I guess, per se.
Yeah.
Okay. What else?
Awesome. I was laughing, Shane, when you said about that's why Nick's a great partner. It's kind of why I think Schreier is a great partner.
Yeah. I like surrounding myself with people who are smarter than me. So, hey, I see some questions in the chat. If you guys don't mind, I'd like to just.
Please.
Yeah, please. If we missed them, go ahead. I thought I covered them, but please.
So yeah, somebody asked about cash on cash. How do we calculate that to return as an average 5.9? So we just basically take the 5-year, cash on cash per year, and then average that out over 5 years, and that's how we got to the 5.9 for that. Somebody else, Chris asked, what does a rebranding package normally cost? That's usually about 25 to 35,000 for the entire package. And ours came in at sort of on the lower end of that. I think we're at 27.5 for that. And let's see.
I'm sharing a couple questions that are in the Q&A just over into the chat right now. Just to help.
Yep. And so, yeah, so to Hitesh's question about the math on the cash on cash, I got to defer to Nick on that. I don't know if he has a weighting formula for that in terms of time component.
Yes,
but
he has a weighting formula, and we also took up the decimal point to punch in some round up number. I can share with the exact detail. It's a rounding error per se, 0.5%, but you get the 5.9.
Mm-hmm.
Candice asked for some of the detail. The other team, what the one out? Okay, I can take it has two folded answers, right? The previous owner team, they're a syndicating team, and their job is to hit the pro forma and get out, right? So we know at least 3 of the 5 general partners of that member. Shane knows 1 or 2. I know 1 or 2, so we kind of overlapped each other. So a couple of different biases. One, they hit the pro forma. They bought it 2.5 years ago. As you know, market went up. So they have accelerated the timeline. Instead of 5 years, they hit the number in 3 years. Could they wait for under 2 years? Absolutely so. But if you think about it, it's a time value of money. If I hit my pro forma already in 3 years out, and next 2 years, I have to do quite a bit of work, and I rather take the money and buy another deal because I'm an active, syndicating team. So that was one of the reasons. That was half of the reason that we believe that was one of the primary reasons they sold. That's because it's that they already hit the number. Market accelerate the timeline, and the other party was that other part is that some of the sellers that we know they're in the market. They have big portfolios, and a lot of the assets are there that they're in has a floating that with rate cap may or may not be in there, but in design they're cash constrained. I know them because I see everybody's working within that, and couple that together, they wanted to get a fast execution. And I believe, Shane, from our end of it, we're able to do the entire capital stack, which is 100% equity on paper that was ready in 22 days, 25 days, right around that time frame, till the 1031 fell out. And that's where we had to do that stopgap mitigation. One of our partners funded that deal, and now we are, refunding that thing and take that partner out, replacing the partner.
So somebody else asked about the strategies in place to boost potential tenants' confidence since the rating is so low now. And that's a great question. That's one of the reasons why we generally rebrand every asset that we buy. So we don't want our brand, our culture associated with whatever was happening before. And so the tenants over the last 2 weeks are ecstatic about our new ownership and the fact that we're coming in and we're fixing things. There's fixing the deferred maintenance. There was, there's always surprises when you buy an asset, right? And so when we closed on this and took over, the skeletons started to pop up that were hidden during our due diligence process. And there was a handful of residents that just didn't have hot water, and why that wasn't disclosed to us and why we couldn't find it is still miffing me. But suffice to say, we've already fixed it. And so those folks are ecstatic now, and we're pumping money into the exteriors. And so our strategy is to really show the tenants that we care, show the residents that we care about their home and our asset that we now own. And then with the rebrand, obviously, we're going to be garnering all those new 5-star ratings from there and really boost our ratings for our brand.
And I know there was one question coming back to this. Okay, this is where the model is. I'm going to show you a little bit more, then we can get into the detail of our calculation. It has the time-weighted average to it. So we look at the pref equity, which is the Walker Dunlop check, and also the retail equity, and also how much of that equity partners are bringing versus LPs are bringing. And we can get into the detail, the mechanics of it off the call, but it's going to take 15, 20 minutes or so, which is fine. But right here, that's the one that we're looking at. It's the 28% of the LP, and this is the 5.9 comes in. I'll double check the numbers on the screenshot. That was the yearly cash flow was, but on the LP side of it, it should be a 5.9%. It's weighted distribution. It's a time weighted return that at the end of the day. So
yeah,
and it's an awesome model. I mean, I don't know whoever wants to get into finance of it, but hey, this is one of the fantastic model I have seen. That's a pretty good waterfall as well. But just want to share, this is 5.9, and I'm taking action to email that to you or send you a screenshot of the yearly cash flow, and it has two coupled it because the project cash flows from year one, then some of the cash flow year one and full 100% of the cash flow for year one and dominant part of the cash for year two goes back to the Walker Dunlop, and the LPs get, and LPs, retail LPs checks comes in at the end of the year two. So when you take the time component of it, it should be at a 5.9. But I think there are some numbers that we missed on this cash flow probably because we hand typed in. I'll update the number and shoot you an email on that one.
Right.
Good question. Thank you for asking.
Thanks, and you've got his contact, Schreier, so you can follow up as well.
Yes, I got it.
And so two things I wanted to make sure. So we're at time for sure. We're a little past time, and thank you everyone. I meant to mention earlier, we have also thank you for a number of partners that are on here tonight. And they're people that may be investing with them. Brooke, Kim, Maria, Hakel. Thank you all for being here and pushing this out, and Candice and Jasmine for all the work you guys put into this as well, and your investors that are coming with us. So just look forward to the opportunity to continue working on this, working with Hampshire. And if there's any more questions, go ahead. I just wanted, we do have this recorded. We will be sharing it, a link to this out to everyone to follow up on as well.
Is that a wrap?
So
Tony had a question. Sorry, Tony.
We are gonna
I think so. I was saying if there was any questions. Yeah.
So wrap from us, unless
I love
anybody
you,
had a
Mike.
question. Mike, Tony.
Tony, did you have a question? I don't know if he. Tony, you still
Tony, if you have a
there?
question, reach out to us, right? I don't know
Yeah.
what question, but I happy to answer your questions.
Yeah, I'll
whatever you
see.
like.
I'm talking with his partner, Jonathan, as well. So
Okay.
we'll see.
I think somebody else is asking about the team again. Well, that was Candace, but now Isabel.
Oh,
Well, I think
yes.
Candace had posted Isabel's question over here was one of it. But
Oh, okay.
go ahead, Schreier, Shane, you want to cover that again? About the previous
go.
team?
So it's a two-folded answer. First one is they are a syndicated team. They hit the pro forma. And interestingly, we had their old OM. So they hit the pro forma. Market accelerated the pro forma timeline from 5 to 3. And they hit the pro forma. They want to be out. They did their job. They want to get out. And the second part, they wanted to get an assurity of the closing. So our team bio says that. Shane's team bio says that. And also the last thing is that they are also similar to us, some of the assets that they have, and that is pushing a burden on the cash. So they wanted to cash out really. That's why they really wanted to get in and get out, which is why when Shane went in before Northmark picked it up, we were able to put this under contract that fast.
Yeah, I actually got an email from one of the previous owners on, as an investor email about the great return they had for all of their investors. They hit a double on it as well and were able to get out.
And also, Ethan, thank you. Appreciate the kind words. Okay, so Mike, back to you. I'll stop sharing and we'll go from there.
Yep. Great. Thanks everyone for coming. You've got a number of people. Go ahead, everybody drop your contacts in there that are, just make sure they have them if you want. Make sure people have somebody to, they know who they're following up with if they want. So just continue to connect. And I was gonna probably miss it. My mom just told me to tell everybody happy Thanksgiving as well, and have a great night.
Happy Turkey Day.
Happy Thanksgiving, everybody.
Watch out for that eggnog, y'all.
Happy holidays. Have fun. Enjoy.
Thank you for
September.
joining us.
Happy
Thank
Thanksgiving.
you.
Bye.
Thank you, everybody.
Thanksgiving.
Thanks,
Bye.
everybody.
Bye, everybody.
Take care, everyone.
Thank you. Bye, Mike.
Great
Bye,
job.
Shane.
Thank you.
Thanksgiving. Bye.
Happy Thanksgiving.
Happy Thanksgiving. The heck?
Trying to, yeah.
We couldn't get on video. We can't get off video. My stuff.